Hello and welcome to State of the Economy. Today we have as our guest Sanjay Nayar, who is the CEO of KKR, a private equity firm, a global reputed private equity firm which has been in India for 7 years, has invested in a host of sectors, and they really understand what is going on in India's private sector because they work with companies both in the equity space, in private debt, even with companies which are stressed and have stressed assets. They help them recover, handhold them. So therefore, we decided that we should speak to Sanjay and figure out what is happening in the economy in terms of private investment recovery or otherwise. Welcome to our show, Sanjay. So, I mean, you've been working in India for 7 years. Before that, you were with Citibank, you were heading Citibank, and now for 7 years with KKR, both in equity and debt. So you've had a, I would say, including Citibank, you've had a good 25-year look at the evolution of the private sector. At the current juncture where we are standing with global headwinds still playing out, private investment not recovering, a bit worrisome, the union budget trying its best to push public investment and therefore crowd in private investment if possible. RBI responding by cutting interest rates by 25 basis points. After all this, how do you view recovery in private investment from your vantage point?
So I think where we are today, forgetting the past, I think we are at the most interesting juncture that either some of these initiatives pay off or they don't pay off. Yeah. Of course, there's always a middle path, which is they'll pay off in due course. But that's the easy way to take an answer. My view is that the government, obviously, in the last 20 months or so, has done a lot in terms of at the ground level, doing a lot of things in terms of administration, governance, announcing projects, getting tracking mechanisms, even debottlenecking some of the stuck projects. So I think that will hopefully all add up and show up. Doesn't show up per se to people like us, but I think it should. Second, I think despite all the global headwinds, I think India's got, I would say, three things, again, just talking of now, going in its favor. The budget's given it the public spending push. Hopefully consumption picks up, both as a combination of some of the wage increases, a bit of disinflationary, not disinflationary, but lower inflation environment, and obviously the recent RBI cut. And finally, hopefully some capex recovery, driven by the public sector side first, but then hopefully followed through by the private sector if global demand picks up. I think right now we have faced a lot of global headwinds, which actually in a way has also affected us locally because there is no getting away.
Especially the Chinese disruption. Yeah.
That is one, and just the fact that exports are down to all-time low. You can't get away from the fact that the global economy and the global economic headwinds have suppressed our own capex. But we have a lot going on domestically. So I think this budget is focusing on getting the domestic thing started again. Add to this the sliver of more policy action, effectiveness of policy action to get the productivity going again so that the private sector can feel confident. I think then you see the path to pick up.
Maybe structural reforms which remain.
Structural, I think, is definitely a nice to have. I don't think we have seen any dramatic structural reforms, and I don't think we are banking on that. I'm saying just what we have announced, the fluent execution of that, a little bit of luck in terms of a good monsoon. I think the RBI obviously playing its position. And I think you have a good recipe to get a pickup in consumption, a pickup in capex. And you know what? I forgot to mention, but foreign inflows have been all-time high. And you put all this together, it has to create a pickup in sort of GDP. What can hold it back? I suppose the global downturn is worse than you think it is, and monsoon is bad, and the effectiveness of execution is poor, which I hope not is the case.
Tell me, Sanjay, you also study other economies. Your organization is a global investor, so you get that the benefit of research from what's happening around the world. There is one view which is held by many global analysts, which is we are not coming back to the boom growth, GDP growth, boom period GDP growth of globally. I'm saying 4.5%, etc. when China used to grow at 9 plus. US also used to grow at 3 plus. I'm talking about 2003, 2010. Europe and Japan also used to contribute a little bit. Today there's a situation where everybody is down. Now India is relatively better off, but if world growth stays, say, around 2%, which is what many people are anticipating this year also, 2 to 2.5%, do you think India can come back to 9% or even 8.5%? Aren't we connected in that sense? So do you think our new potential GDP growth, given the global situation, is no more than 7.5 odd?
That's going to be difficult. If the kind of global scenario you're painting stays, and today we are at between 2.7 and 3% global GDP, I think it's difficult for India to go back to the near double-digit growth. Yeah. But there's still a lot to do between, by the way, where we are today at 7.5 to 10. So there's a lot to do in between. Yeah. Why worry about the 10? And I think what we talked about earlier, and effective execution, getting private sector back in terms of confidence, deleveraging the banks, getting the credit cycle going, I think there is 250 basis points still to go up. Just fixing the domestic climate, domestic demand. We're just so underpenetrated in so many areas. There's enough to do there. Yeah?
So you must do that first.
Absolutely.
Yeah. Tell me, you study various sectors where you are invested in. You have $6 billion invested in various sectors through equity, debt, even stressed sectors. So therefore, you really know the health of various industries, sectors, and within them companies also. Recently, I read a report which came from CMI, Center for Monitoring of Indian Economy, which gave data, credible data, suggesting that the last quarter of 2015 actually witnessed a sudden slowdown. This happened globally also. And stalled projects, actually, in spite of the government's efforts to debottleneck at the policy level, stalled projects actually, the numbers increased. And there wasn't a sharp decline in stalled projects. Now, how do you read that? What's going on? And I believe it's continuing into January and February also.
Yeah, look, I mean, I don't obviously have the numbers, but I think anecdotally what we see in our companies, and ours are obviously not projects, but they're real companies, is that I think growth has been muted. It's a fact. Growth the top line growth has just not been where we thought it should be and where we think it should be in any area, from consumers to logistics to building materials. So I think that's the reason. I think is that consumption, frankly, has come off dramatically. Urban consumption came off first and rural consumption came off after that. I think now hopefully with the budget we'll see urban and rural both pick up. So I think consumption, growth, top line has all been very muted.
And it mirrors in the very low nominal GDP growth.
Absolutely.
Right?
Absolutely.
Of 8% odd.
Absolutely. In terms of projects, we don't have too many greenfield projects, but for whatever we know, I think the private sector saddled with a lot of leverage, some not so good promoters and some well-meaning promoters, and with banks not being able to give them the last mile financing, or the last mile having gotten very delayed, I think a lot of them have just sort of let these projects completely flounder and waiting to be sold. So I think that this needs to wash itself out of the system. So I don't think we should use these numbers of 1 or 2 quarters to say that the quantum of projects that are stuck have gone up. I think there is already a big inventory coming for the last 3-4 years of policy inaction or over-leveraging or misappropriated lending or borrowing or whatever you call it. I think that's washing out of the system. And,
so it'll take some time. You can look at the glasses half full, as these projects eventually will go into...
either they will change hands, they will go into recovery mode, or they will just get mothballed. I hope they all get into recovery mode, because...
that's what you also do, right? Help projects.
No, we do that.
Yeah.
No, we do that, but I think, there's always a point in time when beyond which, project can't be recovered. So you have to catch them at the right point in time, and that's where we work with the banks and try to see if there is a right value for this project, and the banks are happy to get it off their books at the right valuation, and then we can try to resolve them. But all this is still in the making. This is all very new. There's a lot of focus now on getting stress assets off the bank's balance sheet. So it'll take some time. It's not It's not happening in a hurry here.
Now, Sanjay, you're a foreign investor. In some ways, you've brought KKR money, $6 billion in the course of 7 years that you've been around. Now, returns, foreigners look at returns, right? That's the bottom line. Now, I've been hearing this from various foreign investors that returns from India, and so is the case with China actually, maybe for different reasons, but returns from emerging markets in dollar terms has been pretty flat, sometimes even negative. So what is the incentive for foreign investors then to stay and invest more? What is your view?
I think foreigners just love India. I think they love, the democracy. They love the demographics.
Of course, in the long run, they love the promise. They have to be here, but in the medium term,
yeah, I think look, they all love the promise, and I think therefore they continue to come back. And private equity and venture capital as an industry represents, I would say, some of the highest quality investor capital that you can think of getting into a market. And obviously in the hands of competent fund managers who understand a country and understand the entrepreneurs, the working environment. So I think the industry is going to play a very critical role. It's about a 20-year-old industry here as private equity and venture capital. And just taking a step back and thinking about the big fisc that we carry on our head, the fiscal deficit, given the lack of savings that go in the real sector through capital markets and the issues with the banks, I think private capital, both equity and debt, will play a massive role. But now they'll play a massive role, as you rightly said, if the investors behind have seen some returns come their way. Now, 2 decades is not a long-term thing to say that let's write off the country. And actually, people have had okay returns, nothing great, to your point.
If you look at index fund, for instance, 2006
to now,
10 years.
It's been nothing. Like in dollar terms.
Inflation adjusted is flat.
Right. But look, we don't invest obviously in public markets, but even in private situations where the industrial nature of our capital, the value add nature, we go into the companies, we as in private equity, we work with the entrepreneur, we improve the firms, we improve the workings, we improve the profitability.
We take risk, yeah.
We take risk, and we improve corporate governance. Even in those situations, the returns until date for the last, I would say, decade and a half have been quite mediocre by private equity standards.
Like average?
Expected.
You give me a benchmark?
I don't know the numbers, but there are studies by Bain and others. I would say they probably put them in the...
Like barely double digit?
Barely double digit in dollar terms, right? So you've lost a lot, obviously, in dollar rupee. Now, by the way, that's perfectly fine, given, again, the promise that India holds. And just given the fact that last year FDI was about 55 billion, this year I think is going to be even more. And private equity out of that is a very significant part. I think it's more than 60% of that, and venture capital. So back to your question about the investors and their patience and managing their expectations, but then getting real returns is very important for the next decade. Because you can't keep asking for saying, give us a benefit of the doubt and this is India. So you've got to deliver returns. And I think that's, in these markets, 70% returns are macro. You've got to get the macro right. And that's why I think your discussion starting this interview with the macro is the most critical. Yeah. The growth has to be there. Efficiency of doing business, productivity has to come back. And I think the private sector will jump head on. And the moment the private sector jump heads on, I think capital will follow. There's no doubt about that.
Do you think investors would be satisfied with, say, over the next 10 years? You just said the next 10 years would be very critical. People have reposed faith in India, continue to repose faith in India. They like the Indian market. So a high single digit or a double digit, say 10% return, 10 to 12% return over the next 10 years, will it make investors happy?
I don't think so. Not for equity risk.
Not for equity risk.
For debt risk maybe, but not for equity risk. And definitely not for turnaround stress situations. Not at all.
That's not enough. Yeah.
No, it's not enough. And I think what's going to happen as a result of that, given that our industry has matured a lot, we are well-established players, a lot more disciplined in terms of putting money to work, choice of projects, choice of entrepreneurs. We are going to become a lot more selective, right? Have to. And not only do you have a hawk's eye on macro, but even on the micro opportunity, you really have to see whether you can work with this partner. Is there a scope of growth? Because you want to deliver better returns. I think that is absolutely key.
There's one sector, Sanjay, which the Prime Minister has laid so much stress on, and actually this government believes that that the e-commerce space, the IT space, what they broadly describe as startup India space, is something that India can really excel at, and that's where Prime Minister was at the Google headquarters, and Digital India, all kinds of policy frameworks are also being put in place. Is this sector going to give better returns? I understand your point that average across different sectors, so far returns have not been exciting enough. But can some sectors really sort of outshine the others, like the e-commerce?
I'm not much of a digital man myself, but at the end of the day, you have to create real companies who have real customers. You are selling a real service or a product, and you have real margins, whatever they are. So my view is that depends how you look at returns. If it's between round 1 and round 3, maybe somebody will make a handsome return. But ultimately, when these companies have to get listed, or they have to be acquired strategically, or whatever the sustainable growth rate and sustainable return on equity, I think that is what will determine, have you really made money in this business or no. I think for India, where physical retail anyway struggles, I think e-commerce retail makes a lot of sense because it's convenience, it's choice, it's the best of products. And in fact, I think a revolution in logistics, warehousing, and delivery standards.
Logistic costs in India are supposed to be among the highest in the world.
Yeah, but it's going to come down, obviously, right? So
and GST is also partly
correct. It's going to help it a lot. It'll help a lot.
Yeah.
So I think we are obviously very well positioned to make digital and e-commerce in the retail space will be a sort of poised for growth. I think firms have to just be careful about the kind of business model they follow. This whole noise about discounting and,
be more realistic about...
Yeah, a bit more realistic. And as I said, create a real company, which can differentiate itself by having a real consumer, a real product being sold, and some real margins. Then I think over time, the leverage that you have in the system by owning your customer, I think can be huge. So I would say in the long term, yes. But to your question about returns, I wouldn't talk of returns. It's too early. None of them are really exited in a way. There's no real IPO. These are all marks at different rounds of fundraising, and I think we'll be careful.
And recently, Morgan Stanley did a analysis, or their research put out a number that which kind of reduced by 30%, close to 30% the value
so
of
that's the point
a leading e-commerce company in India.
But that's the point I was making. I don't think we should take it as either negative or positive. It's just a mark on a certain round, right? That now we think the company is worth so much. Frankly, that may be wrong or right. Who cares? But the company in question, if it's creating a real brand, it's creating a real marketplace, it's delivering terrific service to its customer base, I think it'll create value over time. Now, whether it's 5 or 10 or 8, I think these are just things that we get thrilled about or depressed about. I wouldn't worry about that. It's too early.
Sanjay, you work with a lot of stressed assets, stressed companies who need temporary funding, who also need some handholding. Now, today the government is grappling with massive stressed assets in the banking system. Finance Minister Arun Jaitley has spoken about the stressed assets in the banking system as a key problem which is being addressed by various arms of the regulators and bureaucracy. And this is the elephant in the room. Now, having worked with your private equity firm has worked with stressed assets, what solution would you suggest to the banks, to the RBI, to the others who are grappling with this?
I think firstly, I must say, this is one thing I think we should definitely compliment this government. They've been extremely inclusive in figuring out a way out of this. So the bankruptcy code and the improved version of that is now in the parliament.
That's a key element.
So let's assume that gets done. Then the question is, how do you implement that, and how does it restart and reinvigorate a real credit market? So there are many steps, and not to bore you with that, I think that at the end of the day, there is always a fair price at which you clear an asset, right? So the second thing really is, at what price do banks sell an asset which is whatever, some category of an NPA which has no potential to revive if it stays on the bank's books. Those are the assets that need to move to the asset reconstruction industry or to strategics.
This has to be done fast.
Done fast, or to management companies, so they can be resolved and they can be cured. And if there is, the banks can get the principal back at least. And if there's any equity value left, I'm sure the fund manager of the asset reconstruction companies can make some money. So I think that's the theory behind this. So really, to your question, the two important things are somehow the banks have to be motivated to sell these assets at the fair clearing price when they have made a judgment that there is no chance they want to support these assets anymore. The fair clearing price means there's a haircut, which means I don't blame the bank chairpersons and chairmen who are worried about investigations on them. I think that should definitely be looked after. And I think you get the flow of assets going, see how the resolution works. And
can I interject you here?
Sure.
One of the issues that the Prime Minister's office, I am told, is grappling with, or has been grappling with, is, and the RBI, is how much haircut should the banks take and how much should the promoter take? Now, this has been a very, very delicate question. Also, it's become a political question today, post this whole Vijay Mallya episode, etc. And the Prime Minister has been saying in his public meetings, it's never happened before, election meeting, that he'll get every pie back of bank money which promoters have.
But I think
how do you determine genuine default from willful default? How much should promoters?
But I think that's the question.
How much hit should promoters?
I think with the new bankruptcy code and everything, I think, look, at the end of the day, when you have a completely defaulted asset, the equity value has to be zero. So the promoter only has the equity, that goes to zero. He's pretty much, that's the starting point, right? The banks have to recover.
So promoter's role is over in that sense?
In a way. But of course, if they are well-meaning promoters, they need help, they can help the company, and I'm sure they can recover some equity back. But the starting point is the banks, the secured creditors, have to get their money back first, right? With what interest is a question mark, full interest, part interest, or no interest. But you've got to get your capital first, and then only there is some equity value that comes. So to complete the first question you asked me on this, the second step for the government to do is to think about kind of a national asset reconstruction company that I think may make it more comfortable for the banks to transact with, because they're worried about dealing with private companies, which shouldn't be the case, but there seems to be a worry. And the final thing is that the banks will need capital. I mean, if they take a haircut and they move the assets, they need capital. So there has to be a very organized recap plan for the banks. In this budget, we have committed about 25,000 crores.
But people are saying it's wholly inadequate.
It's wholly inadequate. So
what is needed is some 3 lakh crore.
I don't know the numbers, but I just think when you put these three things together, I think that's the banking plan, which has to be tackled. And I think the government, I find, has been very inclusive. They've welcomed all the ideas. So I think hopefully in a few months, we'll see something coming out of this as a comprehensive plan.
So various pieces are coming together.
And they're consulting and taking a lot of ideas, which is fantastic.
Recently, Sanjay, the Minister of State, Jayant Sinha, had a meeting with bankers. It was a kind of brainstorming in Bombay, and where he gave out a figure of problem assets, and it was 8 lakh crore. Now, 8 lakh crore is a lot of money. Now, how much of that ends up becoming NPA, one doesn't know. So that kind of gives you an idea of how much capital banks may need over the next 3-4 years. This is besides what the banks needed to meet Basel norms, right? That's separate.
Yeah, that's
you keep that aside. Now, how do you see this play out? Can you think of some creative ways in which capital can be brought into banks without necessarily stressing the fiscal deficit? Because, mind you, fiscal deficit roadmap does not take this into account at all. How do you see that?
Like the problem.
I mean, if you are a policymaker,
you're like bending a theoretically huge problem. It is a real problem, but I think if you get too daunted by that kind of question, I think we'll just get paralyzed. I think you just have to do it the Indian way, which is, we do it slowly. I think we talked about the first step earlier. I think bank consolidation discussion has started. Not sure where it will go, but that's the second step. The weaker banks should get folded up and remodeled or molded or absorbed by the bigger ones. I think an organized recap plan for the better performing banks. And look, finally, if you can ask a theoretical question, I can give you a theoretical answer, which is why own the banks here? So, you know, you don't have to own the bank. But, you know, I don't want to give you that answer because...
No, a lot of people are saying that the government may keep 4 or 5 or 6 large banks.
Why own the banks?
And privatize all the smaller ones.
Exactly.
Right?
Why should you own the banks?
They may recover a lot of
So that's the answer outside the fisc.
So you're in a way you're suggesting what Dr. Arvind Subramaniam describes as creative incrementalism is probably a way to resolve all these issues.
I think we're all realists. Yeah, we've been here too long, so we're just realists. But I think there is some sense of urgency now, which is good. There is sense of purpose. As I said, there's a lot more inclusion of ideas. I think we just got to package this, take them in small bits, and just execute against them. And it will fall together, hopefully.
Yeah, let's hope all these pieces come together at the right time. Thank you very much, Sanjay Nayar, for talking to us. It's a pleasure having you on our show. That's all we have in this edition of State of the Economy. We'll be back with you next week. Thanks for watching.